today is a joint venture, downtown Toronto. It's a multiplex. It's actually 118 and 120 Pembroke because it's two semi-detached properties aligned. They originally were, they may have been single family at some point, but we'll get through all the details and let's get started. So first off, here's an investment summary. Very simple overview. First of all, the asking price is actually 3.1. My plan off the record is to give them an offer below our target, so please do not discuss this with anybody else. It may hurt negotiations if they know that our target is what it is. We can even shoot for lower. So assuming we buy the property for $3 million, we're looking at 35% down or about $1 million. Land transfer tax, legal fees, and so on will amount to $135 on the purchase. So the total capital required is $1,135,000. Now that could be one individual writing a check, or it could be 10 people writing a check for 11 each, or 110 each, 113 each, etc. Or 5 people writing 200, etc. So the total capital required, and of course the ownership is based on the pro rata portion of whatever your investment is. So if you invested $100,000, you'd get approximately 10% of the outstanding shares. If you invest $200,000, you get approximately 20%, etc., etc. Very simple. Let's go through a very, again, oversimplified cash flow analysis. If we assume a 65% mortgage of approximately $2 million at 2.5%, we may actually be able to get financing better than that rate, but let's use that figure for now. We're looking at $107,512 on the mortgage. We've got gross income minus vacancy of $158. Total expenses of $38. That leaves us with an annual positive cash flow of $12,000. And there's a whole breakdown on how the expenses work, and it actually includes management and repairs and all of those things that are necessary, of course. So these are really solid numbers, and we've got all the backup. And anybody that's interested in actually investing in this particular deal, then at the end of this call or when we speak, you'll sign a simple non-disclosure agreement. We'll send you a complete due diligence package with all the data so you can analyze that. You can have your lawyer review and get an independent legal opinion. You can have an accountant review. You can have your entire team, whoever they may be, look at it and go through all the nitty-gritty. But I just wanted to give you a high-level overview. Now, the projected return over 5 years. Now, we look at, in this area, we're looking at a projected market value increase of about 7%. I always like to be conservative, so I'm using 5% in this example. So we've got passive appreciation, and this is a 5-year projection of 828. We've got principal recapture of 308. We've got a positive cash flow of $61,000 cumulative over the 5 years, and that's without accounting for rent increases. In the next line, you see an increase to market rent. I'm going to show you the market comparables and our current rents, and we're definitely under market by about 30%. But again, I'm always going to err on the side of cautious. In that, what if we can't, over the course of 5 years, evict no more or see a changeover rather of no more than a third, then we're only going to get about a 10% upside, which is another 300, and that's a total return of 1.5 on an initial investment of 1. So 150% roughly over 5 years, and an annual ROI of 26%. If we take out the 10% increase to market rent, it's still sitting in at 22%. For a fully tenanted, fully managed AAA location in the heart of Toronto. Obviously a very solid deal, and a property that cash flows to boot. Very hard to find. So let's go through some of the details. It's 40-foot frontage in total by 112. It's a 3-story building with 8 legal units. There's the breakdown. There's parking at the rear. There's about 7,300 square foot of rentable area, and a lot of renovations have gone in the property in the last few years. 6 of the 8 units completely renovated. I've got some photos I'm going to show you guys. And again, over $30,000 per year of rental upside. And as we know, increase in income is directly correlated to increase in market value. And they have done a phase 1 environmental, but we will always do our own due diligence in terms of a proper building inspection. And we use a firm like Carson and Dunlop, who are engineers who have greatest reputation, very thorough. But there's from what we see so far, there's no environmental or structural issues, and we'll double check that. Here's the unit mix, square footages. I won't read those out to you. You can read those on your own. And again, this will all be part of the due diligence package, what that suite mix is. And here's the rental comparables. Again, there isn't enough time for us to understand this, but suffice it to say, we've done the research and we know that the rents in this building are under the comparables in the area. Here's our current rent roll. We know what we're getting per unit. We know what we're getting in terms of a tenant, how long they've been. Oldest tenant has been there since 2009. Newest tenant just moved in before Christmas in a one-bedroom. So we've got a good upside. And the way it works is this: you don't evict tenants, you don't force them to leave. You just wait for tenants to move, and if the unit's renovated, it'll now rent for market, the new market rent, the reality. And as that changeover happens, then you'll start to see obviously changes. So for example, if you look at the newest tenant, October 14th, one bedroom paying $1,350, and we have a tenant that moved in 2011, 4 years ago, paying only $1,174 for a two-bedroom, as a perfect example, where the market rent for the two bedrooms is closer to $1,800. So huge upside here, another upside here, and so on. So we've got some potential. Something else is as well. I'll share with you in a second in terms of upside potential. Another look at the revenues. Here's a pro forma showing the details for realty taxes, insurance, utilities, all of that stuff broken down by unit and also broken down per annum. And again, tons of information, background check on the property. I'm not going to read this out to you. Again, you can read this at your leisure, all the information about the laundry and vacancy rates and so on. And just one little thing I want to touch upon, and that is right here on vacancy and bad debt. We usually budget 5%, but in the City of Toronto, we have a vacancy rate more like 1%. But for the purpose of our discussion, I've used 2%, which is double what the actual vacancy rate in the area is. Again, very, very conservative. Okay. Insurance, utilities, the whole breakdown for all of that. Repairs and maintenance is based on about $700 a unit, which is in line, and we've actually budgeted that into our expense and pro forma. Okay. Here's some photos of the property. Solid detached property. As you can see, parking in the rear, kind of typical of downtown, but very nice area. This street actually has some very architecturally significant properties, and that's going to mean something in a second when I share something with you. Very well maintained, top to bottom. I don't have to tell you what you're looking at, various photos of the property. Really nice property renovations, ultra-modern feel, not typical of rental properties. And when you look in not just the kitchens and the baths, but when you look inside the suites themselves, there's a real pride of ownership. We see good quality tenants in this type of a property. Mature tenants rather than not so much the students. You have some students, but a very good mix, very solid mix with fewer issues than you might see in other rentals. Here's some details on the exterior, the construction, all of that. You can review all of that at your leisure. And I'm sure you can't read a lot of this fine print, but what's important to understand is that the current owner has spent over $500,000 on repairs and upgrades, sloping, roof work, decks, windows, fencing, steps. I mean, it's very well maintained. You rarely see this much work in a property if a client has any intention of selling the property. And I don't know the seller personally. This came through a broker contact of ours. But basically the motivation, as we understand it, is, look, they have this beautiful property. They've maintained it well, and they maintained it with the intention of keeping it long-term. But their situations change. They've got other investment opportunities. They want to liquidate this one and move on to do whatever they're doing. They may be doing a larger deal. And relatively speaking, I mean, for most of us, a $3 million deal is a large deal. But for some people, it can certainly be a small one, and they want to pull their equity out. So here's the location. It's right downtown. It's walk to Ryerson University. It's walk to the downtown district, and probably about, I would say, a 5-minute ride to the hotel, to the hospital district and university. And of course, U of T is literally just a 10-minute TTC ride away. So brilliant location. Here's a copy of the survey for those that want to see that kind of stuff. Here's a Google a satellite visual of where we are, just steps south of Girard. So good little pocket. And here's sort of a breakdown again, another look at what the private rental market is looking at, the vacancy rates and the average rents. And here's the MPAC breakdown, legal description, all of that, taxes, land use controls, environmental. But here's something very interesting as well. On the same street, and I'm not sure what the timeline would be on this, but very good potential that we could look at doing a condo conversion. So in other words, we're not building anything. We're just changing the legal structure of the property from a privately held single family or single title property rather, to a potential condo conversion where, for example, 8 units would eventually turn into 8 condos. We may need to do some cleanup in common areas for security, that type of thing, and we may need to offer it first to the tenants at market price. But that's a potential, and I just give you some numbers here. In that corridor, it's not unusual to see $600 a foot for some interesting suites. And if we're looking forward 5 years, we may see up to $700 a foot. So if we were to convert it, aside from the cost of conversion, the legal fees and the applications and so on and the timelines, we'd be looking at a resale value of about $5 million if we convert. So very interesting upside just in this as well. And there's nobody that can really guarantee this because it depends on when you're making the application. It depends on what the inventory of condos is in the area and you know, what the city's tolerance level is for that. So it's not something. It's certainly not something in the short term. I wouldn't say 2-3 years. It might be 5-6 years when the current inventory of condos is sort of absorbed. But this is also a completely different type of product because when you get these century homes converted into condos, they really are unique and they're very, very rare to find. You know, high ceilings, low rise. So it's not like the buyer of this is going to compare this to a 500 square foot box condo on Front Street, for example. So definitely an upside there. So not much more info for me to review on the webinar for everyone today, other than to tell you if you are interested, here's the breakdown again. The asking price is 3.1. We're certainly going to try to negotiate a little bit less than that. The down payment required is 35%, approximately $1 million. The minimum investment we're looking for is $100K plus 12% for closing costs. That's sort of a rough budget. We never know what the exact closing costs are going to be. The phase 1 is completed and the site is clean, but we will have to conduct a new building inspection, and that will be, you know, a reputable firm such as Carson and Dunlop. That would be the only risk in essence. So collectively, that would cost us a couple of $1,000s. So individually, a couple $100 to give you context. There is a due diligence package with all the information. So if you are interested and or have any questions, the next step is to send me an email, give me a call. We are looking at doing an offer to purchase that's conditional upon due diligence, that's conditional upon all of these different things, and I'll walk you through the process. And basically all you have to do is sign a letter of intent, sign a confidentiality. We'll get all your questions answered, and we'll go from there. My contact info again on your screen, 416-979-0333, and my email info at reccanada.com. I don't see any questions on the chat screen, so I'm going to keep it short and sweet. So if you've written down some questions and you want to discuss it over the phone, you want to send me an email, however you want to do that, please do so, and let's pick up this amazing property. Let's do it together, and let's have fun along the way. This is Simon Giannini, and we're now ending the webinar. Have an amazing day, folks.